$9.2 trillion. That is the amount of US Treasury debt that matures in 2026. Every system has an architecture. Most people see the facade. This is what is underneath. 25% of the entire federal debt stack coming due inside a single calendar year. Foreign central banks are net sellers. Pension funds are already full. Money market funds are saturated. So a single question replaces the headlines. Who is actually buying? The answer is not a country, it is not a sovereign, it is one trade run by a handful of hedge funds leveraged 50 to 1. The Federal Reserve already documented this exact setup. They documented it the last time it broke, March of 2020. This is Chapter 8, the Dominion Archive, the wall and the people standing behind it. For 4 decades the buyers were obvious. Foreign central banks, sovereign wealth funds, allies recycling trade surpluses back into treasuries. The contract was simple, sell goods to America. Park dollars in American debt, repeat. That contract is being torn up in slow motion. Foreign holdings of US Treasuries peaked in 2021 above $8.5 trillion. By the end of 2025, the figure stalled near $8.2 trillion, even as total US debt grew by more than $7 trillion in the same window. Foreign share of the debt is now under 23%. The lowest reading since 2002. The names matter. China held $1.27 trillion in late 2014. By the fourth quarter of 2025, that holding sits near $760 billion, a 40% reduction executed quietly year after year through a mechanism Treasury officials describe as portfolio rebalancing and most observers describe as a strategic exit. Japan, the number one foreign holder, sold an estimated $200 to $300 billion in treasuries during 2024 and 2025, not by choice, by necessity. Tokyo was defending the yen, intervening in currency markets, and the only liquid asset large enough to fund those interventions was the same asset Japan was supposed to be accumulating. Saudi Arabia, once a structural buyer, sits at $135 billion, down from $185 billion 5 years earlier. The pattern is not a rumor. The Treasury International Capital Report publishes it every quarter. The exits are documented, sourced, quarterly. 3 of the largest historical buyers of American debt are smaller buyers today than they were a decade ago, and the wall of refinancing arrives next year. A treasury auction is not a marketplace, it is a plumbing system. 24 primary dealers designated by the Federal Reserve Bank of New York are required to bid on every auction. They are the obligate counterparties. JP Morgan, Citigroup, Goldman Sachs, Bank of America, Barclays, Nomura, the list is public, their balance sheets are not infinite. When foreign central banks step back from the indirect bid, the primary dealers absorb the difference. They are not buying for their own books, they are warehousing inventory until someone else takes it that someone else has changed. In 2014, the largest end buyers were sovereign accounts. In 2025, the largest marginal buyers, the buyers who close the gap left by foreign exits, are domiciled in 2 zip codes that contain almost no people, the Cayman Islands, and a handful of office addresses in Greenwich, Connecticut. The TIC report tracks this in a category labeled with bureaucratic delicacy Caribbean banking centers. That category is mostly hedge funds. In the first quarter of 2022, Cayman domiciled holdings of treasuries stood at $250 billion. By the first quarter of 2025, the same category had grown to $430 billion, a 72% increase in 3 years, while traditional foreign buyers declined. This is not a coincidence. It is a substitution. The primary dealers no longer sell to Beijing, they sell to a relationship desk in Midtown Manhattan, which routes the position through a Cayman feeder fund into the books of a multi-strategy hedge fund running a single trade at scale. That trade has a name, it is called the Treasury Basis Trade, and it is the reason the auction still clears. The basis trade is mechanically simple, it is structurally explosive. A hedge fund buys a US Treasury bond in the cash market. Simultaneously, the same fund sells a Treasury futures contract that will deliver against that bond. The price difference between the two, the basis, is small, often a fraction of a percent. On its own, the trade earns almost nothing, so the trade is leveraged. The fund finances the cash bond purchase in the repo market, posting the bond itself as collateral. Margins on this repo are typically 1 to 2%, which means the fund can hold $100 of treasuries for every $1 or $2 of capital, 50 to 100 to 1. The same leverage ratios that brought down long-term capital management in 1998. But here's what the record actually shows. The Federal Reserve Financial Stability Report, published in May of 2024, identified the basis trade footprint at approximately $1 trillion. By the fourth quarter of 2025, the Bank for International Settlements estimated the same exposure at 1.4 to 1.6 trillion. In 18 months, the trade grew by half, quietly off most front pages. Citadel, Millennium, Brevand Howard, Exodus Point, Capula, Lord Abbott. These are the names the regulators name. The regulators name them because the regulators are afraid of them. The Treasury Department is aware of the dependency. The Treasury Secretary Scott Bessent is a veteran of Soros fund management. He understands the trade from the inside. His preferred issuance strategy in 2025 leaned heavily on short-dated Treasury bills, the exact instrument the basis trade absorbs most efficiently. The dependency is not accidental, the dependency is cultivated. Which means the auction does not clear because of confidence in the dollar. The auction clears because a handful of multi-strategy funds running 50-to-1 leverage on the world's most liquid bond have taken the seat that China and Japan vacated. $1.5 trillion of refinancing absorbed by a strategy that requires uninterrupted access to repo, uninterrupted volatility within tolerable bounds, and uninterrupted faith that the Treasury futures market will keep functioning. When that faith breaks, the trade unwinds. When the trade unwinds, the buyer disappears. When the buyer disappears, $9.2 trillion in maturing debt has nowhere to go. This is not a hypothetical sequence. It has already happened. The week of March 9th, 2020, the Treasury market broke, volatility spiked, repo rates jumped. The basis trade, which depends on stable funding and stable volatility, became immediately unprofitable. Hedge funds were forced to unwind positions to meet margin calls. To unwind, they had to sell treasuries into a market that already had no buyers. In 2 weeks, an estimated $90 billion of basis trade positions were forcibly closed. Bid-ask spreads on 10-year treasuries widened to 10 times their normal range. The world's deepest bond market briefly functioned like a thinly traded penny stock. The Federal Reserve responded with the largest emergency intervention in its history. $1.6 trillion of Treasury and mortgage-backed securities purchased in roughly 3 months. The official label was pandemic response. The functional reality was a basis trade rescue. The Fed has not forgotten. Lori Logan, then head of the New York Fed Markets Desk, now president of the Dallas Fed, spent 2025 delivering speeches that referenced the March 2020 episode by name. The Office of Financial Research published a working paper modeling the basis trade as a systemic risk. The Bank for International Settlements, in its December 2025 quarterly review, used the phrase concentrated leverage in the most liquid sovereign market. The institutions are warning each other in writing. On the record, the basis trade footprint in March 2020 was approximately $90 billion. The basis trade footprint at the end of 2025 is approximately $1,500 billion, 16 times larger. The setup that required a $1.6 trillion emergency response in 2020 is now 16 times the size, sitting underneath $9.2 trillion in maturing debt, in a year when foreign central banks are net sellers and the Federal Reserve Chair is a lame duck. 2 human beings are caught inside this architecture. Their names matter because the record will reckon with them. Scott Bessent inherited the Treasury Department from Janet Yellen in early 2025. His issuance calendar for 2026 is already public. To fund the $9.2 trillion refinancing wall plus the year's projected deficit, the Treasury must auction approximately $12 to $13 trillion of new debt. Bessent's strategy depends on continued absorption by the basis trade, which depends on continued stability of the repo market, which depends on a functioning Federal Reserve counterparty. That counterparty is on a clock. Jerome Powell's term as Federal Reserve Chair ends in May of 2026. His successor has been signaled. The last 6 months of Powell's tenure are transitional months, during which markets price the next regime more than the current one. If that next regime is perceived as politically captured, the basis trade's foundational assumption that the Fed will provide unlimited liquidity if the plumbing breaks becomes a question instead of a guarantee. The math compounds in the background. The average interest rate on outstanding U.S. debt is currently 3.3%. The average rate at which the maturing 2026 stack will be refinanced is between 4.2 and 4.8%. That delta produces approximately $180 to $280 billion of additional annual interest expense. Federal interest payments, already over $1 trillion in 2025, are projected to exceed $1.2 trillion in 2026. Federal interest expense will exceed federal defense spending by a wider margin than at any point since the early 1990s. Every fragment of this is documented. None of it is forecast. The Treasury auction calendar is public. The TIC reports are published quarterly. The Fed Financial Stability Report is on the Fed website. The basis trade exposure is acknowledged in Bank for International Settlements publications. The interest expense figures are in the Congressional Budget Office baseline released in January of 2026. What is not public, what cannot be public, is the moment a single repo dislocation, a single auction with weak demand, a single political appointment perceived as unstable, triggers the next forced unwind. That moment is not a forecast. It is a question of when, not whether. When the foreign buyers leave, the leverage takes their place. When the leverage breaks, the central bank prints. The wall always finds a way through someone. Chapter 5 of this archive traced the foreign exit. Chapter 6 traced Japan's forced sales. Chapter 8 closes the loop. The buyer who stepped in when the sovereign stepped out is not a country. It is a leveraged trade sized 1.5 trillion, running on the assumption that the central bank will rescue it again. The architecture is documented, the exposure is documented, the historical precedent is documented. When the foreign buyers leave, the leverage takes their place. When the leverage breaks, the central bank prints. The wall always finds a way through someone. Money, power, collapse. Dominion does not speculate. We trace. The system keeps moving. So do we. Until next time, question the architecture.